Welcome to Tax Break, a podcast on the tax law brought to you by the lawyers at Miller and Chevalier. I'm Steve Dixon, a tax litigator with Miller and Chevalier. As usual, I'm joined by my colleague, international tax and tax policy expert Loren Pons. Hey, Loren.
Hi, Steve. How are you?
All right.
Good.
So we are recording this on Monday, April 5th, and we had slated this recording time last week when the White House released or outlined its Made in America tax plan, right, in their fact sheet. And we thought, well, that's a great topic for the pod and one that our listeners will want to hear about. So let's get something recorded. And it turns out that our timing was pretty fortuitous because just today, the Senate Finance Committee released a document on overhauling international taxation, which picks up many of the same themes and provides sort of a different take on them. So today we're going to cover I hope a pretty short episode. We're going to cover both of these items, and maybe in what you might call a Biden and Wyden tax rodeo roundup or
That's right. That's right.
something
It's
like
going to
that.
be a lightning round of potential tax changes.
The idea behind Tax Break is to provide listeners with some perspective on select tax issues that we think are interesting. We want to go deeper than what's in the tax press, but stay sufficiently high level so our listeners can follow along without a copy of the regs, or in this case, the White House's fact sheet or the Wyden Senate Finance doc in front of them. As always, first a disclaimer. Tax Break is not intended to be legal advice, and you cannot rely on it as legal advice. Its content reflects only the thoughts and opinions of its hosts or guests, and we don't have any guests today. It's just the two of us. Uh, so let's kick this off with the White House document. And the first thing I think we have to kind of knock out of the way is that we now have it in writing that the White House wants to move the corporate tax rate to 28%.
Right. So this is the official affirmation of what President Biden campaigned with on the trail. He proposed 28%, and here we have the administration's document endorsing that rate, and that will be their starting point for the
And
corporate.
I think you've gone on the record before saying while you expect an increase, you don't expect it to be up to 28%. I think I pinned you down at like 25 before.
You may or may not have pinned me down at 25. I,
I don't know.
I don't, I mean, this is the starting point and we'll see where they end up. But 28 to me sounds pretty high, but there are some significant expenditures that have come along with these tax proposals. So the infrastructure package, which is the bulk of the plan that the White House released, will cost a lot of money, and so it remains to be seen to what extent these expenditures will be paid for with tax revenue. But there is a significant amount of money on the table.
Yeah, and that's a good point. Something we should mention. I mean, this tax plan comes at the end of a almost 30-page document. It's just the last few pages of a 30-page document, all of which is devoted to infrastructure.
Right.
Um, One of the things that the White House mentions here is that this plan, and I think this is talking about the plan broadly, but it says will return corporate tax revenue as a share of the economy to around its 21st century average from before the 2017 tax law and well below where it stood before the 1980s. I thought that was kind of an interesting and strange rhetorical device for the White House to pull out to talk about A, sort of how much corporate tax represents as a share of the economy, not even of the fisc, right, of the economy.
Right. Right.
And and then to compare it not only to before 2017, which was obviously a dramatic decrease, but also where it stood before the 1980s, right? I mean, here we're talking about sort of prior to the 1986 uh, change in the law. So I don't know if you have any reaction to that. I thought that was sort of an odd rhetorical device and one that for a document that's largely aimed at a more generalist audience, I thought those were sort of interesting appeals to make in
In
this
this
fact
space.
sheet.
Right. Right. Well, part of it I think is messaging around the number. So people will see 20% and it's a knee jerk kind of well, this is a 7 percentage point increase from what we just passed back in 2017. So part of it is to kind of combat that narrative and say, in the comparison to the 80s is, it's not as bad as it could be, because the tax rates were much higher then. And then to compare it to pre 2017, it's kind of a being set forth as a remediation of some problems that going down to 21% might have caused with regard to um, the fisc. You know,
Yeah, I think it's funny because there's both here and in the Wyden document that came out today, the Senate Finance document today. There's a kind of and who can blame them, right? It's politics,
right,
but there's a kind of schizophrenia about the relevance of history because on the one hand, they talk about this. Well, look, this it's not 35%,
right,
right? So this isn't that bad of an increase, but also look at these terrible international provisions that are so bad when, and we'll talk about this in more detail, in many instances, the international provisions, even if you think they're flawed, they do more to bring tax dollars back to the U.S. than the system that preceded it for decades.
right. There
So,
is no longer deferral lockout. So we're moving in the right direction, I would say.
right,
But
right,
yeah, there is this is political as well
of course.
as practical, of course. So I would expect nothing less than the appropriate messaging to go around the numbers that they've put on some of these rates.
So one of the things I want to do with sort of the rest of what's in the Biden document, in the White House document, if you will, is one of the things we prioritize here on Tax Break is discussing complex tax topics in sort of plain and easy to understand language. But my goal with this Biden proposal is actually the inverse. I want to sort of take some of this ordinary colloquial politicized language and put it into the terms that our tax listeners will understand. So I'm going to read you a few little snippets here from the Biden document, and then we can talk about what they're actually referring to because they don't refer to particular code sections or even acronyms that describe particular regimes under the code. So,
Right, right.
um,
They don't want to, and they shouldn't. I mean, this is a broad-based messaging document, so
right. So
understandable.
So the first one is it says right now the tax code rewards US multinational corporations that shift profits and jobs overseas with a tax exemption for the first 10% return on foreign assets, and the rest is taxed at half the domestic rate. So what are they talking about here?
So they they are talking about GILTI. The proposal put forth by the administration is the same as what President Biden previewed on the campaign trail. So eliminating QBI, doing a country by country calculation of the GILTI inclusion, and raising the rate. So in that blurb you just read, there was a reference to incentivizing offshoring of certain activity that has been, in my view, mischaracterized. The data has not borne out the assertion that having an exemption of a certain percentage of your qualified business asset investment will encourage companies to locate hard assets overseas. But that is their position. So the response is to eliminate that 10% of the value of your tangible depreciable asset base as a tax-free return, tax-free in the U.S. That is, and then doubling the rate on GILTI. So right now the statutory rate of GILTI is 10.5%. If you take into account the 80% foreign tax credit, that rate goes up to 13 and an eighth. Um, the administration is proposing a rate that is 75% of the domestic corporate rate, so 21% compared to 28%. So still somewhat of a benefit, recognizing that, I guess, a tacit acknowledgement that there is going to be there are going to be operations overseas, so there's a bit of a tax break in terms of the rate differential, but not as significant as what is currently available.
Yeah, and I mean we should. I think again this is sort of let's contextualize, right? I mean for many years corporations were able to operate offshore and defer their offshore income under, with exceptions like Subpart F.
Right.
There was still a regime that allowed deferral. And GILTI was seen as a step in the right direction in the sense that it was right from the sense of U.S. taxpayers not permanently deferring income overseas. Um, and so GILTI was, as sort of those of us in the transfer pricing fold would talk about. I mean, GILTI was meant to allow foreign companies with foreign operations to earn a routine return on those operations. And there are many U.S. taxpayers who have significant PP&E outside the U.S., and lots of them for very valid business reasons, because they can't transport all of the goods that they manufacture from the US to everywhere around the world, or because it makes sense to co-locate manufacturing or production with other activities in home countries.
Right.
And so this was seen as a kind of pricing mechanism, right? That, 10% is about what you should be earning, and then anything else are these sort of intangible returns. And we can see this rhetorical shift here from the the focus in TCJA on intangibles, and intangibles being what's driving the sort of offshoring of revenue and base erosion stripping. Now we've sort of flipped and we're talking about tangibles, and they're saying, well, no, now this allows this rewards you for offshoring tangibles. And it's like, well, I mean,
Not
that seems
quite.
to me not quite the intent of the provision.
Right. No, that's right. The 10% of your tangible depreciable asset base is exactly what you described. It's meant to approximate a routine return. Everything above that is a supernormal return, and it is a proxy for intangible assets, whether they are there or not, whether they're owned abroad or in the U.S. There is the assumption, the presumption that anything above that 10% routine return is attributable to an intangible asset. It is true that this proposal shifts from you looking at intangibles and trying to gauge where those returns are and how much of those returns are appropriately taxed in the U.S. if they're generated abroad, to a calculation about a tax-free amount of some sort, and the focus is on tax-free, and in my view, ignores the valid reason for having a routine return in a jurisdiction where you're operating. It understands also that you are going to be taxed wherever you are,
That's
um,
right.
and as we've seen the evolution of GILTI, there is a high tax exclusion for certain amounts. So there's kind of built into the architecture the understanding that um, GILTI should and will only apply if you're not paying a certain level of tax where you're operating, and you should be entitled to a routine return that's not subject to tax in the US.
So the second one I want to sort of read to you, and we can talk about, is it says the 2017 tax law allows companies to use the taxes they pay in high tax countries to shield profits in tax havens, encouraging offshoring of jobs. So what's this a reference to?
This is a reference to the blended approach of calculating your inclusion. So right now, once you've excluded your high tax jurisdictions, there is a blending of everything else that's left. And so under the current rate, it's 90% of the U.S. tax rate, so 18.9%. If you're not subject to that rate of tax and you're in the jurisdictions in which you operate overseas, you are allowed to kind of blend everything below 18.9. So it could be 18, it could be 2, all blended together. And the proposal is that there is no blending. So it's a country by country calculation for your GILTI inclusion.
Then there's a couple of provisions in here that talk about a minimum tax. So it says that Biden's plan will eliminate the rule that allows uh, it says eliminate the rule that allows U.S. companies to pay zero taxes on the first 10%, which again is the GILTI piece that we've talked about.
Hmm.
And it will increase the minimum tax on U.S. corporations to 21% and calculated on a country by country basis. So this is meant to be the GILTI being calculated on a country by country basis, and then 75% of the 28% rate is 21,
Right, right.
right?
So eliminating the Section 250 deduction, which dovetails nicely with their plan to repeal FDII because they're both in the same code section. So you get rid of the 50% of deduction for 951 Cap A, and you get rid of the the FDII entirely, which is their proposal as well.
They're also proposing a sort of this minimum tax, right? And this is, I take it that when they talk about minimum tax, there's a couple of different things in this proposal. One is the minimum tax that is effectively this 21% GILTI rate. And then the other one is this 15% min tax on book income, which isn't an international provision. That's a domestic provision, right? Or it's a or sort of a worldwide provision, I guess.
I think it's worldwide, and this kind of goes to there was some press last week with several companies that were profitable but didn't pay any corporate tax over the last 3 years. And the article acknowledges, and there are many reasons why this might be the case. Right now, we have 100% bonus depreciation, which really goes a long way to helping people reduce taxable income, and some other incentives in the the tax code for domestic operations. So there are a lot of reasons why that might be the case. Be that as it may, the Biden administration is of the view that corporations should be paying tax always. And so looking at book income is a proxy for calculating that tax when a corporation may not have any taxable income. Um, and ostensibly, these two will not operate in tandem. It will be an either or
Right.
scenario.
Right.
But we have
It's not a min tax of 36% worldwide
right, right.
and
Sounds
even
like
high. It
sounds
sounds
like
like 1986.
man, it does. So that's the idea that even if you don't have taxable income, there can still be some tax assessed based on book income.
And then there's an overture towards a kind of a regime that would look to whether the other country in which the U.S. corporation operates itself has a strong minimum tax law. So it says the plan denies deductions to foreign corporations on payments that could allow them to strip profits out of the U.S. if they're based in a country that does not adopt a strong minimum tax.
Right. So that's a reference to the beat. And this is really an articulation of exactly what the inclusive framework suggested the US might consider in the Pillar 2 blueprint that came out last year. And so there, um, recognizing that there was a concession with regard to GILTI coexistence or GILTI grandfathering, as it used to be called, um, the inclusive framework recommended that BEAT, in fact, be turned off when there's an outbound deductible payment to a recipient, as you mentioned, in a jurisdiction with a compliant income inclusion rule or minimum tax. The administration has proposed a repeal of the BEAT, which I don't think anybody is going to be upset about. And then, in the instance that the recipient does not have a minimum tax jurisdiction, there's some kind of mechanism to turn off that deduction. But as I understand it, it would not be under 59 Cap A, so they would have to redraft something that would operate similarly to the BEAT in terms of denying the deduction, but maybe not as complicated and burdensome as the BEAT is.
And the one provision that the White House proposal does call out by name is FDII,
Mm.
and it says that FDII gave corporations a tax break for shifting assets abroad. I mean, I guess that's sort of an interesting reading of FDII. I always thought that FDII was meant to encourage companies to bring intangibles onshore, not to shift assets abroad. But why are they putting the spin on FDII, and and is there any validity to it?
I feel like FDII is the perhaps one of the most misunderstood provisions in the code. Their argument, QBI is a concept that's in GILTI, but it's also in FDII, and so any complaints they have about QBI in general will operate um, with respect to both provisions. I don't think that their allegations are correct in the FDII context or in the GILTI context. I was um, teased lightly last week as being one of the last defenders of QBI. So you may not be talking to the right person. But FDII was really meant to equate the rates. So if you're going to serve the foreign market from the US, or if you're going to serve the foreign market from abroad, the rate should be the same. And that's what FDII does. It gives you 13 and an eighth effective rate by operation of a deduction. Um, just as GILTI, even though the statutory rate is 10 and a half, when you take into account the 80% foreign tax credit, it gets you to the same 13 and an eighth. They are of the view that FDII does not work to incentivize domestic activity or bring as much innovation, or they prize R&D investment more than what FDII is trying to do. And so the repeal is suggested, and then in replacing FDII with unspecified, we don't know what they are, R&D incentives, the administration feels that they can better kind of spur investment and growth domestically.
There are a couple other, I don't want to go into these, but there's a couple other provisions about eliminating special preferences for the oil and gas industry or fossil fuels. There's a provision about ramping up enforcement against corporations with the acknowledgement that the IRS has been underfunded for some time. But the last thing I wanted to just bring up with you in the Biden proposal is this notion that they're going to do more to make it harder for U.S. corporations to invert. And I feel like we went through this however many years ago, 5 or 6 years ago, with
Right.
there were some anti-inversion regs.
Yes. Yep.
And so are they sort of scaring up ghosts here a little bit, or is inversion still sort of a real enemy of a of an equitable international tax
I think
plan?
it's more of a relic than a real threat today. You know, with a lower tax rate and reduced abilities to earnings strip out of the US, I'm not sure that inversions, at least since TCJA, are particularly popular or attractive. I don't really, we haven't seen what these inversion inhibiting or disincentivizing provisions would look like. We still have the 78, 74 regs. There are um, provisions that kind of make it more difficult. They're proposing repealing the BEAT, but there are penalties kind of baked into the BEAT for inverted companies. Um, so we'll have to see what it looks like, but um, I don't know. Certainly with the higher rate, they might become more attractive. I don't know. It's kind of counterintuitive, but I don't think that they're the threat that the administration is making them out to be. And certainly, we haven't heard any news of any companies
Of big
inverting.
inversions. That's
Yes,
right. That's right. And
recently. So
around the time of those anti-inversion regs, I mean, there were several major multinational deals that were pending or being held up by
right,
those regs.
right.
Um, okay, well let's flip over to the Wyden document or the Senate finance document. overhauling international taxation. Obviously, this is focused purely on international stuff. I think it's fair to say that there's a little bit more colorful or invective language in the, in the Senate Finance document. Um, and some of the same, and doubling down on some of the same um, contextualization or
Framing of the
decontext
issues.
decontextualization of what. So I mean, right off the bat, right, they come out hot and say GILTI gave big corporations a huge reduction in the U.S. tax rate on foreign earnings and created incentives to offshore jobs. I mean, again, this seems to me slightly misleading, given that for many corporations for many years, the U.S. tax rate on foreign earnings was zero because they didn't repatriate them. And
Unless
so
you had subpart F, you were doing all right.
you were doing all right. And whatever GILTI lays down, whether it's 13 and an eighth or whatever, that's more than zero. Um, so and it, then it goes on and makes the same assertion that the White House said about, giving multinational corporations the ability to earn tax-free income by putting tangible assets abroad. I mean, again,
Yeah, no,
not clear,
no,
not
no taxpayer I've heard of has really been jumping up and down about the prospect of paying a reduced rate on GILTI, as opposed to domestic tax rates. It's not. I would not characterize it as a giveaway, and I have not heard of anyone, building a new factory overseas instead of in the U.S. to take advantage of a 10% exemption on your QI. No,
right,
it's
right,
just. But this is a political document,
right,
almost
of course.
more than it is a policy document, and so um, I'm not surprised to hear it characterized that way.
Um, and then the Senate Finance Committee talks about the GILTI rate, and they kind of punt a little bit on what the rate should be. So we know that Biden is at 75%, and they suggest this possibility of what they, I think they admit, effectuating a fully worldwide international tax system, which would be sort of the
Nobody wants to
territoriality,
go
right?
back to that. Yeah, yeah,
Right. I mean, and that would be that's what would happen if you equalized the GILTI rate and eliminated the 10% routine return.
right.
If you equalize the GILTI rate with the US rate, it would just be worldwide taxation on income.
It would. It
Yeah,
would be. They do equivocate. They mentioned prior Democratic proposals ranged from 60 to 100%
100.
of
Yeah,
the corporate rate, and so we'll have to see. I think they're giving themselves a little wiggle room.
to play.
It's interesting to watch or to see the where these proposals dovetail and where they diverge. And the administration has its goals and its plans, and then Congress kind of deals with what's possible. So they know that they've got the slimmest of slim majorities. They know that within the Democratic caucus there are various priorities, and so it's interesting to see the spin from the Senate point of view, which is we know we got to get folks on board, and we're just going to keep our powder dry on some of these numbers. They don't talk about the corporate rate. They don't talk about
No,
a GILTI rate.
right.
They're not. They talk about we'll get to the beat, but a higher than 10% rate, but no real number other than more than 10% for base erosion payments. So that shows kind of the fluidity of the discussions on the Hill, the negotiations, keeping in mind administration's priorities. They're a little bit constrained by what's feasible.
So a willingness to play ball, if you will.
They're certainly willing. I mean, they're not going to come out with something that's 180 degrees from what the administration has proposed, but you know,
Uh, So they also adopt this sort of country by country proposal with GILTI. So that looks like that has some traction, at least between Senate Finance and President Biden, and they reference the foreign tax credit system as the way in which that is effectuated. Um,
they
but
do,
but
but they're
yeah,
softer. They're softer than then President Biden's proposal, and that they acknowledge and even endorse the high tax exclusion for GILTI that's in the regulations. And they say, okay, well, once we kick all that out, we can separate, first we can separate your operations between low tax and high tax jurisdictions based on this high tax exclusion concept. We'll kick out all the high tax ones, and then we'll look at low tax jurisdictions and your GILTI inclusion. So, um, you know,
So rather than ending up with a 200 and whatever basket foreign tax
exactly.
credit system, they signal a willingness to go to like maybe a two basket system for
Two
foreign
baskets
tax.
plus the other baskets that we have. So
We've had more baskets before than we have today. So
we have, baskets contract. It's like you don't. It's a big Easter egg hunt or it's a little Easter egg hunt. How many
that's right.
baskets do we need?
Um, they and it's funny. There's this line here about which sort of throws shade in a funny way, right? It's ironically, you remember this line? Ironically, the Trump
Ironically.
Treasury Department already provided all the necessary operational details as part of their regulations, creating an elective high tax exclusion for GILTI. So, haha, we're going to change GILTI, but we're going to use your system to do it.
Yes. They
I
said
can't,
ironically. I mean, if I were at Treasury, my feelings might be a little bit hurt. It's like it
right?
wasn't really by accident that that these regs came to life.
Right.
There was a lot of
Right.
work, a lot of work that went into them. But ironically, it just so happens that there's a mechanism here that dovetails with what we want to do.
I wanted to ask you about one line in here. It says that the interaction of GILTI with the foreign tax credit regime can create perverse incentives. And it says a prime example, taxes owed under GILTI increase when a corporation invests in research and development in the US or expands a US headquarters office. Can you just, for the listeners, explain why are they even saying that mechanism exists?
Well, they're talking about expense allocation and apportionment for foreign tax credit purposes. And so um, the way that the rules work, any expense that you have to allocate to the GILTI basket will drive down your income in the GILTI basket over worldwide income. So when you're calculating your 904 limitation, any dollar of expense that you have to allocate to the GILTI basket will reduce your your foreign tax credit availability. And so, um,
And thus act like a penalty
right,
on US expenditures.
right. And depending on the expense, and for the ones they mentioned, this is true, some of the domestic spend will have to be allocated ex US. And so it will impact your GILTI count.
So then they turn and talk about FDII a little bit, and it it's it suggests there's a line in here: if FDII retains an offshoring incentive and cannot drive valuable investment in the U.S., then it will never be a sustainable provision, and it is almost certainly not worth keeping. It's clear. The
Almost
executioner
certainly.
sharpening his sword for that one. Uh, but again, right? I mean, this is it's this inversion of the notion that you know FDII was on its face meant to be a sort of an incentive to keep intangibles onshore, not an incentive to move tangibles offshore.
Right, right, right. And so I think, I mean, they are not quite as bullish on FDII repeal as the administration, and they say, well, there are some ways that we could maybe make it work, and they've got this, what do they call it? Uh,
Yeah, so that's
your
the
DII, but it's not intangibles, it's innovation,
it's innovation. Yes,
innovation income.
innovation. So we'll just swap out the I, and that will
Yes.
make all the difference.
And
Yeah.
that way, we can keep the statute. We'll just change. We'll keep the acronyms. We'll just change the words. But there's not a lot of they mention R&D expenditures and worker training as potentially acceptable expenses that would fall into this to this new DII concept. But there's a lot of work that needs to be done around that if they can figure out a way to retain it. Otherwise, you're right. They say if we can't do it, then it has to go. So
Right. Right.
we'll see.
They do come out strongly in favor of equalizing the FDII and GILTI rates, which
Which is
presumably.
news to me because I thought they were equalized. But hey, the statutory rate, it is true on GILTI is 2.5, but they are disregarding the fact that there's an 80% foreign tax credit. So that makes that rate 13 and an eighth, which is the same rate as FDII.
And why would they? Well, like what? Why gloss over that
I don't know, Steve.
finer detail?
I don't know. I mean, it's like we said, this is somewhat of a political document, and it goes with the narrative that
The
operating
current.
overseas is just a complete and total giveaway. This significantly reduced rate on income generated from serving the foreign market from abroad is a corporate giveaway.
Let's turn last to the beat. One of
Mm-hmm.
your favorites, the beat. There's some discussion here about how the beat can be more focused on actual base eroders through the use of a second rate bracket. So what is that idea, or what's this?
What is
What are the
this?
seeds of
This,
that idea?
this mysterious second rate. So the beat is modeled after A&T. So everything, once you kind of tip over this threshold, it just means that everything is assessed at a 10% flat rate, 10% on everything. Once you've made all your adjustments for preference items, so on and so forth, you've gotten over the 3% threshold, 10%. Their proposal is to separate out your regular taxable income. Once you tip over this threshold, regular taxable income would be taxed at 10%. And then your base erosion payments would be taxed at something higher than 10%. And so you don't get to lump everything together and assess the minimum tax based on this single universe, one tax rate. It would create two universes, two tax rates.
Thus targeting the base erosion payments as sort of with a higher rate to make it to discourage them more strongly.
Right. So the beat now, you can think about the base erosion payments as kind of a tipping point. Once you get past that, then everything is assessed 10% on gross.
Yeah.
Ostensibly, they would keep the gross, and just the rates would change.
Right. And then in one last sort of thing that I wanted to point out, and this is the kind of thing that shows that this is a political document. You'd never write this kind of thing in a brief because it would be thrown right back in your face. Um, but
Luckily, we're not going to court.
yeah,
They
but
won't have
they
to
were.
defend us.
It's just pure advocacy here. The beat was not just a policy to target base erosion and domestic investment. It was also an offset used to help Republicans slash corporate taxes by more than 1.3 trillion. Uh, yeah, that's sort of what. just like all of the international provisions in here are meant to fund the infrastructure bill that they're expressly coupled with. And
Exactly. I mean, at least the Biden plan is clear that when they get into the
these are
tax
pay
discussion,
they're
they're like, "Hey, this is going to fuel
these are pay fors.
the
Yeah.
the expenditures. This is going to pay for the expenditures that we've just spent the prior 24 pages outlining." And really, the corporate rate plus the GILTI modifications that that the administration has proposed, at least, will pay for almost, I would say, more than half for sure.
Of the
Maybe
infrastructure
maybe
cost.
maybe 75%. We'll see.
Wow.
Yeah,
Wow.
yeah. The proxy, like the rule of thumb, is 100 billion for every percentage point of the corporate rate
Okay.
um, is raised or lost, depending on which way the rate's going. Um, and then the GILTI modifications would probably raise another seven or so, so 1.4, roughly 1.3,
Interesting.
1.2.
Great. Well, Thanks. I think that was a good, quick coverage of what we're watching, and
Oh
we'll see
yeah,
how these.
this is just beginning. Like
It's just beginning,
we'll see where everything goes. The real test is turning ideas into legislative text. Um,
and
harder
and
than some people might think.
and getting something done before midterms.
Oh yeah, we
Yeah,
do have a hard deadline coming, right? So
that's right. That's right.
um, yeah, we'll see how things unfold. But it will be an interesting year in the international space for sure.
Great. Well, thanks. As always, if you have podcast ideas or want to reach out to us for any reason, feel free to shoot us an email at podcasts@milchev.com. That's podcasts plural at milchev.com. Thanks, Lauren.
Thanks, Steve.